Certainly. I have to say we're delighted with the results that we're communicating to you today. We saw organic growth strong once again at 6%. We saw a 30 basis point improvement in our adjusted operating margin, so that is now 26.4%. We did see our adjusted diluted earnings per share increase by 12%. Cash conversion remains strong at 100%, and we're delighted that we are recommending a dividend increase of 15%. In addition to that, to reward our shareholders, we're also announcing a further 1 billion euro share buyback. So we're very pleased with the results, and this has allowed us to reward our shareholders.
Pleased with the results. I'm looking at your 2024 guidance and compared with the actual diluted adjusted EPS growth of 12% in 2023. Got to be honest, Kevin, it's quite a modest aspiration of mid to high single digit when you've just turned in 12%. Is the idea here to give lower expectations and then try and outperform a little bit later on?
Well, our margin, our EPS guidance does reflect a couple of things. We do expect improvement in our adjusted operating profit going forward. That's discussed in our press release. But there will be some headwinds. For instance, in 2023, we had the benefit of significant interest income because interest rates were quite high. So we earned interest income on our cash deposits. With interest rates coming down, we expect that will be less in 2024. We're also expecting an increase in our effective tax rate due to the Pillar 2 legislation that will become effective in 2024. So that's incorporated into the guidance that we've given you of mid to high single digits on EPS.
Kevin, good morning to you then. Your net debt has also increased by double digits, in fact, 16% on a year-on-year basis. Don't you want to just talk us through that and whether you have any plans of bringing that down as well? Is this levels that you're still comfortable with?
Well, actually, I think we are comfortable with our net debt to EBITDA ratio that we're reporting today. We're reporting 1.5 times net debt to EBITDA. I would say that, we're comfortable at a target rate of 2.5 times. So we are certainly below that. And I think this gives us ample room to invest and take advantage of opportunities as we move into 2024.
Yeah, and your recurring revenue then, that tends to be a little bit more predictable because of the kind of needs that consumers perhaps have in good or bad times. But does the advancement of technology mean that you can maximize that part of your business, your recurring revenue, a little bit further?
Well, certainly, our recurring revenue is 82% of our revenues. And this year it's grown, or last year, I should say, in 2023, it's grown by 7%. It is recurring. The professionals that we sell to, tax accountants, lawyers, doctors, you need to do your taxes year in, year out, good times or bad times. And people always need, the advice of doctors and the treatment of doctors, regardless of what the economy is doing. So that recurring revenue stream is very predictable with high retention rates.